Stocks and ETFs might seem the same thing, but they're not. They have a lot of similarities, but also a lot of differences, so let's discuss them. Let's first discuss the similarities. They are both investments, which means that they are both and held in order to make money and appreciate over time. They are both traded on an exchange, which means that you can buy these assets and sell them at any time when the exchange is open. It's important to note that these investments can go both up but also down. One interesting thing about them is that they usually are treated the same under tax laws, which means that you can use the same tax principles on both of them. They can not only appreciate in value, but they can also pay out dividends. However, it's important to know that they don't have to necessarily pay out dividends, however, it's an option. Now let's discuss the differences, because they're really important. First difference is what you own. When you buy a stock, you're holding a stock of a specific company. This company can have different divisions, for example, Google owns YouTube, but also the browser as well. But you're buying the same company. On the other side, when you're buying an ETF, you're buying multiple companies and multiple assets at the same time. Next up is risk or overall volatility. Stock tends to be much more risky and volatile because it's one company. If it fails, it can go down really quick. However, it's important to also know that ETFs are not necessarily safer. For example, you can have an ETF that's just technology stocks and they can be more volatile than a single defensive stock, for example, a Coca-Cola. Another difference is the return potential. With one stock you can lose a lot, but you can also gain a lot. It's quite likely that a stock can appreciate a lot, but also go down a lot. However, with ETFs, you're limiting your return potential, but also you're limiting how much you can potentially lose. Because when you have multiple assets, they usually don't produce such strong results. However, they also limit your downside. One major difference is the effort and overall knowledge you should have when investing into ETFs or stocks. When you're investing in a stock, you should probably know a lot about the company, since it's way riskier and it's just one company. On the other side, with ETFs, you can just buy one ETF and you don't necessarily need to know that much about every single company, especially with hundreds of them. Another part is the effort. When you want to buy multiple companies, let's say more than 10, it's probably smarter to buy an ETFs because you can just buy one ETF that holds many companies, and that would be quite hard to do with just buying individual stocks, which you have to monitor. Lastly, costs. The minor advantage with stocks is that you don't pay management fees. On the other side, ETFs are passively or actively managed by companies such as Vanguard or BlackRock or any other provider. This means that they usually get a small cut. This cut is quite small, but it's still there, and it's an additional fee you pay. Let's quickly summarize. When you buy a stock, you buy one company. This means that you have high risk, but also high reward. However, owning a stock requires research and active decisions. When you buy an ETF, you buy a basket of companies. There's lower risk, and the companies, since you have hundreds of them, the outcome is more stable. This also diversifies you automatically, and this style is more for passive investing that doesn't require so many active decisions.